Partha Pratim Sengupta with us to talk to us about Q1 FY26 numbers. Let me first start off, sir, by understanding what's happening in the microfinance book. What is it doing? When do you start to see visible improvement with regard to that sector?
So if we just go a little back, so last year, the problems and the challenges started from, I would say, from month of July, August onwards. And if you have seen the books of all the institutions who are having microfinance for that year, there was tremendous impact. There was an adverse impact in the financials, and there were many slippages, and NPAs were high, delinquencies were high, the growth book was almost muted, and we were also affected. Bandhan, we are having a substantial exposure in this finance, so we also affected. So Q3 and Q4, the profits also came down, as you know, for the year. And in fact, Q3, Q4, we also got some of the CGFMU money from that year against the guarantees. But let me tell you that Q4, I told that we expect the Q1 and Q2 of this financial year, the challenges would remain, but maybe a little bit better. Maybe that's what we have anticipated. And sequentially, if you see that that has exactly happened for that year. So microfinance book continues to have the challenges because from 1st April, the guardrails have been imposed. And you know the impact of guardrails will be there for 2-3 quarters. So we expect that by end of the second quarter, probably the impact of the guardrails would go away for that year, and we can actually then have a much more stable industrial look for that year. So as of now, I can say on the ground also, because of the guardrails, I think the advances are not growing to that extent. If you look at the entire industry book for that year, it has come down. It has come down, and for us also, sequentially, we have come down by 6% for that. But good thing is that the delinquency has been a little bit controlled. The slippages have come down. The SMA2 book has actually come down, and SMA1 has remained stable. So from these two factors, I can say that going forward, probably the slippages will be contained, and then actually we can look for a better growth. So Q2 will remain a challenge, but definitely not the same challenges what we are facing now. For the industry has definitely is, I would say, tuning to the latest guardrails for the day. It will take some 3-4 months for the day. So Q3, Q4 onwards, we are expecting that we will have a stability in this segment and we can grow. So for the entire year, we have kept a growth of 8% to 10% in this segment. And we are still hopeful that, yes, at the end of the year, financial year, we will be able to achieve that 8%.
So your credit cost was 3.5% for Q1 FY26. While it's improved for sure, your full year guidance is 2.5%. Talk to us about where you see the Q2 number. How quickly can it taper? Are you comfortable with that 2.5% credit cost guidance? Also give us some color with regard to your slippages. Where does it normalize at? How does it come off?
Yeah, so you see the credit cost also last year was 2.5%, and we kept the guidance at the same level for this year too. We said that Q1 would probably the credit cost would be same when I met the investors and analysts in Q4 for that year. But thankfully, the credit cost has marginally improved from 3.9% to 3.5%. And if this trend, as I told, that the delinquencies are coming down and the SMA2 book is coming down, if this trend continues for the day and with new disbursements, new advances, I would say that this credit cost would definitely improve. And so we have still kept a guidance of 2.5% by the year end. So we are expecting, say, around 3%. It will be here in this quarter, in the Q2 for that year. And then going forward, it will be a better, say, Q4, we may reach a 2%. So that on an average, we can get a credit cost of 2.5%. We have not shifted our guidance as of yet.
Okay, got it, sir. So 8 to 10% growth on microfinance. What about the overall portfolio? And give us maybe a 2-3 year view as well. What is the growth looking like overall?
So let me tell you, growth in the entire advance front will happen. So this year we have projected a growth of 15 to 16%, and we are still hopeful that we'll be able to achieve it further. And going forward also, but if you look, say, for microfinance, so let me tell you that we have a very clear guidance. We are transforming and we are moving more towards secured books. So today my secured books have gone up from 48, 50 to 52% for the year, and going forward also this book will increase. So EV segment, I can tell you in this microfinance, the guidance will be more or less at 8 to 10%. So that will not aggressively what we have been doing in the past, we will not do. Let me make it very clear. So we will be keeping that moderate guidance for that year. But overall book, yes, we will grow by 15 to 16%. That has been our growth for that. If you look this quarter also in my secured books, the housing sector has grown by 15%. The wholesale book has grown up by more than 40%, and our retail has grown more than 70%. So that trend will continue.
Got it. So I just want to quickly clarify, FY26 loan growth, what would that be?
FY26, we have just made our strategy up to FY27. So FY26 also 15 to 16%, and 27 also 15 to 16%.
Sir, with regard to margins, where does that leave margins? You've given us a growth guidance. How is margins coming under pressure? How much will it shrink? Give us that perspective.
So let me tell you very clearly that NIM will be moderated. We have already passed 25 basis point in the last quarter. This 1st July onwards, we have passed the balance 75. But the thing is that I have got some plus points. The first thing is that my books, almost 50% of it is under fixed rate. So that is not getting impacted. Number two, we have already decreased our deposits rates in April, and we got an immediate effect of 19 basis point. I would say positive effect in the first quarter. Going forward, as and when my fixed deposits get matured, which are mostly residing in the 1-year book for the day, so definitely I will get much better, much lower cost of funds, and definitely that would moderate. I would say the NIM also, whatever the effect is there, the adverse effect would come down for the day. The third is that slippages, as I've told you, that slippages are showing some good growth for the day. So as we can contain the slippages, definitely the interest income will be more for the day. So taking all these into factors, while there will be a moderation, again, I'm telling you, I cannot say that I will keep the NIM at the same level what I have done it for June quarter. No, it will not happen. There will be a moderation, but again, with the increase in the business, in the quantum of business, we will definitely try that my profit remains for that year. That is definitely our target.
Okay, so my last question is on cost to income as well as ROA. I'll roll both of those into one. Is there scope for cost to income to come down? And therefore, what should your steady state ROA be at?
So ROA also, we have given a guidance of 1.5 by the year end, FY26, for that similar to that of the last year. The Q1 as expected, so I think 0.8 was the number, and we have achieved that for the day. And as I've told you that with the slippages coming down, so these are all the effect that if I can contain my NPAs and if the slippages I can prevent, and we are making lot of efforts in recovering the amount also for the day. So including the claims that we are yet to get almost 100 crores from the ECLG in respect of the ECLG's guarantee and all other things. So going forward on this, we are still hopeful that probably the 1.5, what we have said for this year, would be maintained.